Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, coming to you from the annual meeting of the World Economic Forum here in Davos, Switzerland. Coming up, all the big issues: the falling price of oil, global inequality, the threat of another recession. We debate and discuss the issues with industry leaders and see if anyone's got the answers to avoid another global financial crisis. In a world of social media and technology, networking has become commonplace. You go online, you click, you chat, and you're connected. But once a year, here in the freezing cold in the Swiss Alps, the world's biggest and most powerful networking event still has its place. Welcome everyone to Davos and the annual meeting of the World Economic Forum. Business people, economists, politicians, NGOs, you name it, they're here, along with quite a few media, we must say as well, to cover the world's economic outlook for 2016. They come up with a theme each year. This year it was Mastering the Fourth Industrial Revolution, again focusing on technology. But not surprisingly, with the current state of the global economy, it was other events which took centre stage. You're guaranteed two things in Davos: snow, lots of it, and economic news, usually positive. But on day one in 2016, the news was mostly bad. A fall on the Chinese markets overnight, another drop in the price of oil. For so long we've talked about economic recovery. Now it's a situation potentially worse than the financial crisis of 2007. The Organization for Economic Cooperation and Development reckons we're out of ammunition to fight the downturns. So it's time, according to the Group Secretary General, for a change in thinking.
We continue to rely on the central bankers to doing more QE. They have run out of ammunition, because they have been the heroes of the last 4 or 5 years. Now, it's a time for the finance ministers, for the trade ministers, for the environment ministers, for the innovation ministers, for education ministers. It's a time to go structural. It's a time to go green. It's a time to go institutional. It's a time to go social. It's a time to do all the structural measures that we did not take.
But is it too late? Markets and currencies are already crashing. And here in Europe, where the brakes were so strongly applied, there's a real struggle to get moving again.
I think we should have worked harder, particularly in Europe, but also elsewhere, to cut debt, to restructure debt more aggressively than we did. And I think we made the mistake in not boosting demand more strongly at once. I think I've taken this for years. We introduced austerity too soon in the UK. The Eurozone has been much too austere for too long. So we don't get any momentum.
And so the Davos talk goes on. How bad are things really? What do we do now? Opinions are as abundant as the snow. You know, some people might struggle with a slogan that says committed to improving the state of the world when they feel it's just a bunch of rich people in a very expensive ski resort in the middle of winter. But to be fair, what the World Economic Forum tries to do in Davos is bring people together, literally from all over the world, to get them talking. And that includes those who might be struggling, shall we say, with international relations at the moment. Think of Russia. In the year since the last Davos meeting, it's become involved in the war in Syria, fallen out with Turkey, and been accused of adopting a Cold War mentality. Finding partners here is important business.
Even in the US recently, Hillary Clinton and Donald Trump mentioned that Russia should be treated with respect. So I think we believe that isolation that many people try to impose is hopefully going to become the thing of the past this year, as many people understand that Russia wants to be an integrated, stable player in the world economy and do a good thing in the world and also in the Middle East.
But with oil taking a dive below $28 a barrel, and so much of the global economy dependent on its health, even Russia, with that hopeful tone, knows 2016 will be tough. And to think, it's only January. Yep, just 3 weeks into 2016 and we've already got a pretty good indication of where things are going, and it's just not looking good, is it? Now, you saw in that report the Secretary General of the OECD, the Organization for Economic Cooperation and Development. His name, Mr. Gurria. Very animated and very passionate he was too about what we need to do, and I'm using the royal we there, to get ourselves out of this financial dip.
This has been happening now for many months, actually. We've all announced that we were going to downgrade our economic projections since some time. The IMF came out yesterday, will come out in the next few days and we'll say that it's a little weaker than it used to be, and we make a big deal about China, not because we did not know that China was going to decelerate. Everything that we said was going to happen is happening actually, but because of this turbulence in the stock market. Do you remember the stock market tanked in August? Nobody does, and nobody cares anymore because you can't decide on economic policy based on the behavior of the stock market.
No, you can't, but this time the difference between now and 2007 is that we're watching this happen. It's almost happening in slow motion. It all hit us back in 2007. This time we know about oil, we know about the markets, we know about China, but there's seemingly nothing we can really do about it.
Well, yes, there is this Yogi Berra type of, déjà vu all over again idea.
I thought you were going to talk about picnic baskets there.
Yeah, but basically you can do stuff. The only question is we continue to rely on the central bankers to doing more QE. They have run out of ammunition, because they have been the heroes of the last 4 or 5 years. Now, it's a time for the finance ministers, for the trade ministers, for the environment ministers, for the innovation ministers, for education ministers. It's a time to go structural. It's a time to go green. It's a time to go institutional. It's a time to go social. It's a time to do all the structural measures that we did not take in the last 4 or 5 years because we were depending on simply...
all long-term things, though, aren't they? Those are all long, which is good. We've got to think long-term, but we've also got to brace ourselves for a short-term crash then.
Kamal, if we had decided that these were long-term issues in 2008 and 2009, where we were too worried fighting the short term, perhaps we would now be in better shape. Now, it's never too late to start to do the long-term things. But if you delay them, and if you delay them, and you delay them, before because it was so good, why did you need to take measures? Then we tanked. It was so bad. You could not take the measures. Now we're in the post-crisis suffering the fact that we did not take the measures. So we should take them right away. So this is what we have to do. Get on with it. It's not the question of shrugging or saying we can't do anything about it. Yes, we can do things about it, and of course there are impacts in the countries that are exporters of raw materials or oil. They will suffer most.
Can I quickly ask you?
There's an upside for the others.
Can I quickly ask you about that? Because oil is a major factor, below $28 a barrel. OPEC still not cutting production. Doesn't it seem a bit, I don't know if you want to use the word selfish, but they're taking actions which protect themselves and aren't looking at the bigger picture?
Frankly, the bigger picture in general, 1 year ago we said this is a bonus. The drop in the price of oil is good for the world. 0.5% plus or 1% plus, it's going to be better for the whole of the world economy. And no, we had all the wind in our sails. We had low prices of oil, we had low interest rates, we had the weak euro, and of course things have not happened yet. And why is that? Productivity remains frightfully low. Why is that? Well, do the people know that investment is growing at 2 or 3% instead of 7%, which is a cruising speed? Are people aware of the fact that trade is growing at 2% instead of growing at 7%, which is the cruising speed? Do people know that credit is not flowing, particularly to the European areas, but also in the medium and small enterprises in many of the developing countries, because banks have become so absolutely, cautious, but also because they tightened the conditions. So how do you want, and of course, who were the big engines of growth in the last 10 years? Emerging economies. They've dramatically decelerated. So you have all the 4 cylinders of the growth engine in the last 6 or 7, 8 years that are now at half speed. Why are we surprised of what's going on?
We are willing to set up special economic zones that will employ these refugees. Now, when you do that, not only are you giving the refugee the sense of economic self-sufficiency, which will lower the cost of hosting refugees, but you also give him skills and training that he will put to good use once he returns to his country.
New technology is always dazzling, but we don't want technology simply because it is dazzling. We want it, create it, and support it because it improves people's lives.
All those technologies I would say, come on us like a tsunami. They are disruptive and they have numerous consequences on business, but also on governments, on society, and even on us individuals, because one of the big differences is that those technological changes we are witnessing now will change us.
My call to action here is simple. Embrace the obligation to your workers as well as your shareholders. It's good for workers, it's good for your business, it's good for your productivity, and it's good for society. And there's nothing about it that doesn't recognize and support and reinforce the capital markets.
Last month in Paris, world leaders reached an historic agreement that provides concrete framework to reduce carbon emissions. This was an important first step, but we're a long way off from claiming victory in the fight for our future and for the survival of our planet.
Right, so what I want to do at this point is take you on a little bit of a walk. About 5 minutes in that direction is the media centre. They keep us well away from all the action. We come for a walk or grab one of these golf carts to come up here, to come to the meetings. And right up here, if you look behind actually, is all the live positions. You know, when you see me on Al Jazeera with those lovely snowy backdrops, we're up there. That's our friends at another channel, of course. So we come up here and this is where things happen. You get members of the Congress coming out here to do interviews because not everyone's even allowed in there. It's very, very tightly controlled. And I guess this is what people say about Davos. It's the elite. In that building there, that's where the 1% are. Remember the 1%? And I guess there are groups who come here and sort of try to gently remind people about that. Say a group like Oxfam, an NGO, who actually recently put out a report about 62 people in the world holding as much wealth as half of the world's population. And you can bet some of those 62 people are in that building as well. Now, I spoke to Oxfam's Winnie Byanyima about this, what she calls the inequality in the world and what they're trying to highlight.
Our report shows the pace and the scale of the crisis. We are showing today that 62 people own as much wealth as 3.5 billion poorest people, half of humanity. And that this has been increasing rapidly. 2010, this figure was 388. Last year was 80. Today it's 62. In a few years' time, it will be just 10 people owning the same wealth as half of humanity. This is dangerous because it slows economic growth, such levels of inequality, it traps people in poverty, and it sparks social unrest. Our report also shows that economic inequality isn't just a blip. It is in fact hardwired in our economies. Rich people, powerful companies have come together to rig the economic system so that the whole economy is working for a small 1% at the top and excluding all the rest. So it's not inevitable. And we're here to propose solutions, and we're asking governments and business leaders to tackle it, and to tackle it urgently.
Some of those 62 people, I suspect, would be here. Have you met any of them? Do you plan to meet any of them?
Yes, we know who they are. There are 53 men and 9 women, and indeed some of them are here. But this is not about them. It is about a system that has been rigged over time. Over the last 30 years, what has happened is that big business and rich individuals have used their power to skew the rules of the economy in their favor. So 30 years of deregulation, of privatization, of financial secrecy, of globalization has resulted in exactly this. One example that we give in the report that really shows how rigged the economy is the issue of tax havens. Tax havens don't help anybody except the wealthy people who are able to stash away the money they make and not have it taxed for the public good.
So one of the central issues we've talked about here at Davos has been the price of oil. Of course it is. It's been something we've talked about on Counting the Cost for many weeks now. At the centre of the issue, and I'm talking about what happens behind the actual price, is the oversupply. Too much oil, not enough production cuts, and you get that lower price. Now, drowning in oversupply, that was something we heard here this week, and it came from the International Energy Agency. We had a chance to talk to the Director General of that group, Fatih Birol.
All the time. It is a dominating issue here. more than climate change, more than refugee crisis, more than China. Oil prices today and what will it be tomorrow? This is the main topic.
And that's the thing, we don't know what it'll be tomorrow, but we know, I think, that it's probably going to go down a bit further. I mean, do you feel that we haven't reached the bottom yet?
I think when we look at the 2016, there is a lot of oil in the market already, and not many consumers, demanders. On top of that, we expect, on top of the already a lot of oil in the market, we will see Iran to come, about 300,000 barrels per day in the next few months, and plus maybe another 200,000 barrels per day. So there'll be more oil in the market, and this means 2016 may well be a year we still see oil prices under pressure.
So then shouldn't someone be getting on the phone to the Saudis and the big players in OPEC and saying you need to cut production? We know why they don't want to. They don't want to lose their market share. But the greater good here, it's just going to keep driving the prices down if they don't cut production.
Of course, this is up to Saudi government and other Middle East producers. But two things are important to note here. One, as a result of the low oil prices, huge amount of investments for oil are deferred or cancelled. 2015, 20% decline. 2016, an additional 16% decline. And in the history of oil, this is happening for the first time. 2 years in a row, oil investments are declining, which means that 2017, or even maybe earlier, we will see a rebound of the prices, number one. Number two, when we look at the impact of these low oil prices, Middle East producers are hurt the most together with Russia. According to our analysis, if the prices remain around $30 2016, Middle East will lose economic value equivalent to 20% of its GDP. Huge loss. Russia the same, losing about 10% equivalent to their GDP. So low oil prices hurt the economies, but we should also see that this is not a price level which will be with us forever.
So it's bad news, isn't it? All this news for all these oil economies. Forgive me, I'm sinking in the snow here. But you think about all the places, the Middle East countries, even the United States, places in South America, Venezuela, and of course Russia. We know how important oil is to the Russian economy. Now think about Russia at the moment. How does it deal with the lower oil prices? How does it deal with its currency falling? In fact, while we were here, we had the ruble hit a new all-time low against the dollar. And how does Russia deal really with its international standing? We know it's had a lot of problems in the last 2 years with international relations. There's a whole storm of things happening at once here, which could make it difficult for Russia to do business. We spoke to the CEO of the Russian Direct Investment Fund, Kirill Dmitriev, to see how the Russians are coping.
It's a very big challenge for the Russian economy because it's very much dependent on oil, but also we believe that lots of this decline has already been factored in the markets and the price of the ruble. So definitely a very big challenge, but it also creates some new opportunities as well.
But, well, you mentioned the ruble there, new lows against the US dollar. Again, as I referred to before, these are acute problems which you do need to deal with now. You might have factored in some of this, but markets react as they do, oil markets react as they do, they go down, people lose confidence.
Yes, but for example, decline of ruble actually stimulates lots of sectors of the Russian economy. Our agricultural sector, which is very important for Russia, is now offering some of the lowest price agriculture products in the world. So for Russia, it's an opportunity to restructure, to really diversify away from oil, and we can see lots of investors actually wanting to move in and take advantage of some of the lower valuations they're seeing. And in the previous crisis, I think I mentioned to you earlier, Russian market recovered 7 times in the next 2 years from the crisis. So definitely a very challenging time, but we as a fund see lots of opportunities, and lots of our co-investors believe in those. And for example, they doubled the amount of commitments they have with us. We gathered $25 billion from our partners to jointly invest in Russia.
You've got a problem, though. I hate to be blunt about this, but Russia's got problems on the international stage with international relations. In the last year, again, since you and I have spoken from here, things haven't been going well internationally for Russia. When you come here and you want to do deals and talk to people and get them investing, do you strike problems?
Well, first of all, we'll announce a major $1 billion investment jointly tomorrow with a major Middle Eastern player. So we see people investing a lot with us. You know, Saudi Arabia committed $10 billion. Recently, we had a very good visit of Emir of Qatar just on Monday, and they're increasing the automatic portion with us. So definitely some people are concerned, but we also see that many people start to understand and more respect of the Russian position, even in the US.
Respect the Russian position, what do you mean?
Well, even in the US, recently Hillary Clinton and Donald Trump mentioned that Russia should be treated with respect. So I think we believe that isolation that many people try to impose is hopefully going to become the thing of the past this year, as many people understand that Russia wants to be an integrated, stable player in the world economy and do a good thing in the world and also in the Middle East.
So we've covered off a lot of the big topics, haven't we? Oil, falling markets, potential recession, we were talking about Russia then, all these things. We also want to talk about something which maybe you don't know much about, Europe. Now, yes, of course, you know a lot about Europe. You know Greece, you know Portugal, you know Spain, but some of the other countries we haven't heard about where we should perhaps be looking. And I'm talking in this case about Finland. Finland is being touted by some as the next sick man of Europe. Perhaps not the next Greece, but perhaps also heading in that very same direction. Alexander Stubb is the finance minister of Finland. I had a chance to chat to him. He was very open and realistic about the job ahead of him.
Yeah, definitely. I mean, you can look at it from two perspectives. One is the pessimist, the other one is the optimist. The pessimist only looks at the negative figures, 4 years basically of negative growth. We have municipalities and the state which is increasing its debt levels. We've just popped over the 60% per GDP ratio. We can also say that the labor situation is not good, unemployment is increasing. But the optimist said that our predictions are about 1% growth for next year. The oil price is pretty good for us. The ECB's monetary policy is pretty good for us.
Is it the pessimist or is it the realist? Because the signs that Finland is exhibiting, we've seen in other countries. There's a touch of the Greece there. I would like. Sounds harsh, but
I probably wouldn't draw any parallels to that. But I think I'm an optimistic realist, which means that we need to do all the major labour market reforms and competitive leaps that we promised to do. If we do that in the next 6 months, then we'll start seeing growth and employment improving. I think all the signs are there, but we need to make that shift happen. It's not going to happen by itself.
And when you say we, is that Finland or Finland and Europe? Because the European situation it hasn't improved enough.
Yeah, well, actually, if you look at the Eurozone growth rate there are not too bad if you compare to the last few years. But it is basically Finland. We need to do that change. We were an economic miracle from the 1990s to 2008. Then we basically crashed. We went from a top 30 country to top 3 country, and now we've dropped again. But we need to make that shift, and it basically means structural reform.
Can you tell our viewers who maybe don't know their Finnish history, what went wrong? Where did that crash come from?
There are many different elements to it. Number one was that we basically overexpanded our welfare state, and we expected a 3% annual growth. When that dropped, we couldn't do it. Then there was actually a combination of the information technology industry, which is very strong in Finland, Nokia, for instance, and the paper and pulp industry going down at the same time. And on top of that, we had the financial crisis, and we hadn't done the structural reforms. One final point, we did a labor wage agreement in 2007, which was way too expensive, so that was part of the course as well.
What do you worry about for 2016? Again, not to be the pessimist, but what do you worry about the pressures on Europe? I mean, we're talking social pressures as well, refugees and the migration crisis that's been going on as well.
Yeah, I actually think that there are 3 colossal challenges for all of Europe. Number 1 is migration and asylum seekers. Number 2 is the euro and the economy. And number 3 is basically terrorism and security. I think this is like a 1950s and 1990s moment for Europe. In the 1950s, coal and steel was integrated. In the 1990s, the Cold War ended, and we went for European Union. We need to do something similar. I think the answer to all of these 3 crises is more integration, not less. At the same time, I know it's not a popular thesis.
And that is it for our Counting the Cost special from here at the World Economic Forum in Davos. Hope you've enjoyed it. Hope you've learned something from it. You can watch the episode again online if you want at aljazeera.com/CTC with all our other episodes, of course. And you can get in touch with me. You can tweet me at KamalAJE. Use the hashtag AJCTC when you do, or just drop me an email, Counting the cost at aljazeera.net is the address. It is minus 10 degrees out here, so I'm going to get myself inside. I'm going to leave you with some more of the beautiful scenery we've seen here in Davos during the week of the World Economic Forum. Thanks for watching.